Mortgage applications are plummeting. This is according to a new survey from the Mortgage Bankers Association, which has been conducted weekly since 1990 and covers more than 75% of all residential mortgage applications in the United States. And here in the US, mortgage applications fell a whopping 10.6% last week, ending February 16th, after falling an additional 3.3% in the prior week. Refinancing also fell 11.4% after falling 3.6% in the prior week. So what's the reason behind all of this carnage in residential real estate? Well, it has to do with the average 30-year fixed rate mortgage here in the United States, which rose to its highest since December of 7.29%. You can see here, we're up almost half a percentage point from the lows reached in January, where we dipped below 7%. And of course, we're off the highs of 8%, but it looks like we're making a resurgence back for that 8% mark, which of course is challenging the highs that we last saw in 2000, right as the tech bubble burst. Now, of course, this has led to a massive decline in home purchases. Purchases are down 10.1% after falling 3.2% in the prior week. And you'll note that currently, these are the lowest home purchases we've seen on a weekly basis since 1995. And that's pretty remarkable. This is worse than the great financial crisis. I don't mean to be hyperbolic. This is a very literal thing I'm saying. This is the Mortgage Bankers Association U.S. Purchase Index. You'll see here that we reached a top in 2005 of around this 500-point mark. And at the lows of the great financial crisis, the housing bubble bursting, right? We reached 159 points. We're currently at 133 points. So this is quite serious. These high mortgage rates are really dissuading buyers, and it has caused this huge decline in new home buyers. So what is going on here? Well, this is due, the mortgage rate increase is due to strong economic data releases this month, which has caused investors to pare back their expectations for Fed rate cuts in 2024. Now, with expectations for the Fed to lower policy rates off the table, buyers are doing one of two things. They're either biting the bullet and taking the highest mortgage rates in a generation, or they're choosing other means like renting an apartment, delaying plans of having a family, which is awful for the birth rate, or living at home. In fact, according to a recent study, almost 1/3 of Gen Z are living with their parents due to not being able to afford a house of their own. It's really bad. So what's next? Higher mortgage rates reduce consumers' disposable income as more money is allocated towards mortgage payments. This results in decreased spending on other goods and services elsewhere in their lives. This secular slowdown in consumer spending that we're experiencing, seen most notably in home purchases being at a multi-decade low, results in decreased spending on other goods and services elsewhere in their lives. Of course, this means a reduction in economic activity, also known as a recession. GDP, the way we measure it, relies heavily on spending, and as consumers slow down thanks to higher interest rates, a symptom of which are these higher mortgage rates, you see a recession inevitably, and that's what we're experiencing right now. We're on the cusp of that. Now, the other factor, the other thing to consider is that higher mortgage rates squeeze banks' revenue and their net interest margins, as the spread between interest rates on mortgages, or one of their primary sources of revenue, and the rate that banks have to pay on deposits and other forms of things that they offer, narrows. Now, this can impact banks' profitability, of course, especially if they're unable to offset that margin compression through other resources. And of course, as consumer spending slows down, as rates are higher, banks get squeezed more. This hit to banks' profitability, if happening for a long enough period, inevitably leads to illiquidity and financial system instability. Both lead to the Fed stepping in and slashing rates to stimulate consumers in the real economy and the financial system, and may warrant even more direct measures should that not be enough, like we saw in 2020 and 2021 with helicopter money, which of course led to rampant fraud, a whole host of other issues, and the 9.1% price inflation and still sticky price inflation that we're experiencing right now. Maybe even saving a bank or two along the way with some FHLB loans and discount window borrowing. All roads lead to a boom following the Fed-engineered bust that, despite the Fed's best efforts, is looking increasingly likely, as stubborn CPI inflation has forced their hand at keeping rates higher for longer to the detriment of consumers and the banks who rely on extending credit to them. That's what I'm watching. Talk to you guys next time.